Front and center this hour, bracing for more volatility. What a flurry of new trades could be revealing about the road ahead for stocks and your money. We debate that with the investment committee. Joining me for the hour today at Post 9 at the New York Stock Exchange. There's Joe Terranova and Sarat Satir in the house. Steve Weiss, Amy Raskin with us as well today. Let's check the markets. We did have a pretty nice bounce off the open, though. You can see here a lot of that has now evaporated. Dow's good for just less than 70 points. S&P 39.87, and there is the NASDAQ, which is still positive as well. But, Joe, I go to you first, and I referenced this series of trades that the Wall Street Journal noted from the CBOE and their data. More call options betting on the VIX will rise have changed hands on an average day in February than at any time since March of 2000. What does that tell you about what may lie ahead for volatility in this market?
Tells me where sentiment is, and sentiment right now is back to being uniquely bearish, the way it was in the fourth quarter. We're seeing that type of bearishness play out once again. I wouldn't get too excited over this little bounce that we're having today. S&P has to get above 40.50 to reverse a lot of the negative momentum from last week. So a lot of the conversations that I've had in the last several days, and really it's in the financial advisor community, is if they're sitting on cash right now, right, what's the incentive for them to be compensated to take the risk where the runway right now seems a lot longer with monetary policy? There's so many unresolved answers, whether or not the earnings contraction that we saw in the most recent reporting season is going to evolve into an actual earnings recession. So why step in? And there's competition right now for equities in the form of a higher yield. It's just a very difficult environment, and that is extrapolating, leading to this consolidation type range.
Oh, how things, Sarat, change in the course of 2 to 2.5 weeks. I feel like that strong employment report was kind of a gut punch for the bulls because it only reinforced what the Fed was going to do. You had some tough Fed speak since then, but the bulls had the upper hand, at least to start the year. Sentiment seemed to have changed. Momentum was back in the market, and then here we are questioning everything again.
Yeah, Scott, you're absolutely right. So, I mean, when we started the year, leading indicators were coming down. Inflation numbers were kind of subdued. We were talking disinflationary. Then all of a sudden,
right, Jay Powell said it like 1,000 times
right,
in the news conference.
Disinflationary, right? And then all of a sudden, you get that strong employment number. The PCE comes out stronger. All of a sudden, the bond market now in the short end is going higher and higher. The back end is still lower, so that's kind of conflicting. But when you get to your point, Joe, a 6-month Treasury, I was having a talk with a client today at 5%. And, you know, do you take that opportunity with excess cash or side on cash and say, we would always talk about if you have cash on the side, what are you going to do with it, right? Right now, you have 5% for 6 months. So what are you going to, you know, what's the downside of that?
There are even some daily money markets that are out there competing with the yield you're getting from treasuries at, you know, plus 4.5%, which, to your points, makes the bonds versus stocks argument, you know, the most compelling that it's been in an awfully long time.
Look, the market is always, and that's why there's volatility, and you began the show highlighting the volatility, the increase in actions for options during the month of February. There's always volatility in the market. There's always the appearance of having uncertainty, but this seems like the uncertainty that's been permeating throughout 2022 is now extending into 2023. It's staying around a little bit longer than investors are comfortable with. And I think that feels a little bit different than the way we felt over the last 13 years since the great financial crisis. And you don't have the liquidity there anymore, Scott. The liquidity is not there to kind of sop up the pessimism. So, listen, I told you the other days, I'd be surprised if we go back to the lows from October. I think we're safe there. But I also don't think we're racing back towards 4,800. I think we've got to mark time. It's the enemy of the market right now.
Yeah. Guilty until proven innocent, I suppose, Amy, is the way that these rallies are going to be judged. Mike Wilson, you know, triples, quadruples down today. Given our view that the earnings recession is far from over, we think March is a high-risk month for the next leg lower in stocks. Ultimately, we think this rally is a bull trap. Look, I think you've been fairly negative, but I feel like over the last couple of times you've been on, you've tried to see a little more positivity in things. But here we go. Sentiment feels like it's all of a sudden reversed back to being overly negative.
Well, I think what we're seeing now is that the economy is running hotter than people expected. I mean, much hotter than people expected. And inflation's running hotter than people expected. So as long as those two are going together, I'm not overly worried about it. I think the bear case scenario is that inflation stays very high and the economy falls apart. And we're not getting that. Sort of the bull case scenario is that inflation comes down and the economy stays okay. We're not getting that either. And that's what I think people were looking for coming into the year. But obviously, employment and inflation are the two metrics that people are focused on. And so your bearishness or bullishness depends on what your outlook for both of those are. And if they're going together as they are now, that they're both hotter than people expected, I think we are kind of in this trading range.